Rates are going up. Hey guys, I'm Zach Sykes at Homestead & Co. Today I want to chat with you a little bit about rates going up, what that means to us, how to track it, and how we should communicate with our clients about what impact that's going to have on our real estate industry, right? So first off, let's understand what affects the mortgage interest rates. Now for this conversation, I'm strictly talking about those government loans, those QM loans, those 30-year conventional, 15-year conventional FHA, VA type loans that most people get on that owner-occupied house, right? Those are the ones we're going to talk about today. A lot of people think that the interest rate that the government talks about, you see on the news, the Fed raising or lowering the rate, is what affects the mortgage interest rates. And guys, that's just not true. That's one of the big myths around rates. The rate that the Fed, right? And when I say the Fed, I mean the Federal Reserve Bank in the US, what the rate the Fed sets affects. What the rate the Fed sets affects is the rate at which banks lend each other money. So it doesn't really affect us as consumers, but it does get slowly passed on to us in other ways. So as a real estate professional, what do we want to watch for that will affect interest rates? There's a couple big things we can watch. We can watch the MBS, or mortgage-backed securities. If anybody's ever seen The Big Short or heard about 2007 financial collapse, right? Go back and watch that. They'll talk a lot about mortgage-backed securities and CDOs and all that fun stuff. But we're gonna watch the price that mortgage-backed securities are being traded on the stock market. Guys, those are big bundles of mortgages, thousands of mortgages bundled in together in one big fund. People buy and sell and trade at different rates of return. The other thing to watch, guys, is the 10-year Treasury bond. That's the US Treasury bond, the 10-year. As the price fluctuates on that, it's going to affect our interest rates you have with our local lenders here on the ground. That's what we're watching to see what rates do. Now that we know what we're watching to see how it's gonna affect rates, what does it actually translate to in terms of how does it affect me or you Johnny homeowner, Johnny homebuyer as they're buying that next property, right? I'm gonna give you this example. At a $250,000 loan amount, that's not purchase price, that's loan amount. If I go from 3% to 4%, that's a 1% jump at $250,000. My payment goes up $139 a month. Guys, I see this all the time right now, making offers $10, $20, $30, $40, $50,000 above asking price to try to get that next home. Guys, and if we're willing to do that, $130 a month on a rate from 3 to 4 really shouldn't affect us significantly in our sales market. Now, historically, when rates have risen, you've seen a shorter term actually influx into the market. All those people that were sitting on the sidelines, waiting, thinking they had time because the rates are gonna be low for a long time, see it start to creep up, and it pushes them back into the market to say, hey, I better lock this in before rates really start going higher, right? So in the short run, we're gonna see increased demand back into the market. That being said, we're still in an extreme inventory shortage. We just simply have not built enough homes over the last 10 years. And so our inventories are still gonna be low. It's our opinion, now guys, if I don't have a crystal ball, it's my opinion, our estimate, that it's not going to affect the market as much as it typically would when rates rise. And guys, with the way inflation is, we want rates to rise. Nobody wants gas to go from $2 to $4, or a gallon of milk go from $4 to $8. The way the Fed helps control inflation is raising those rates. And so we want rates to go up slightly for our big economy in the US here, guys. So what does that mean to me as a real estate agent or as a homeowner, guys? If I've already got a loan locked in at a 30-year fixed or 15-year fixed loan, nothing changes, my rate doesn't change. This only affects people buying or refinancing new properties. So just to recap, even if rates jump up 1% more at a $250,000 loan amount, that's only going to raise the payment $139, which guys really isn't that much compared to how much we're spending at the pump right now.